Our office, Gary Queen is involved with a number of banks and has good relationships. When he can't get loans, the first thing he says is, call Dell. Call Dell. Dell will get it for me. Well, Dell is Senior Executive Vice President of Florida Bond and Mortgage. They started in 1957. They have 2 offices, one in St. Petersburg and one in Fort Lauderdale. They service over about $650 million worth of loans. And interestingly, they have no loans in foreclosure in their portfolio. They have a few that are in workout.
Yeah.
Yeah. But Dell?
Right. Well, I'm Del Goforth, and we have our office in Pasadena, South St. Pete, and Ryan Cockman, my partner in the back's with us here. And no kidding, George did cover a lot of stuff that I was going to cover, so I decided I'd just kind of change my MO and wing it. And basically kind of tell you, what we do, start out with. I mean, we primarily represent insurance companies and pension funds. We represent Southern Farm Bureau, American Express's insurance companies, Farm Bureau Iowa, just a number of insurance companies, Thrivent for Lutherans, etc. And insurance companies, unlike banks, are basically long-term lenders. I mean, most of our typical product would be a 10-year term, fixed rate term, with a 25, maybe 27-year AM. Insurance companies primarily do not do 30-year AMs because there are a lot of them are regulated by the states that they do business in. But they are serious long-term real estate players. They exited the market, when crap hit the fan, and they just kind of sat back and waited to see what was going to happen. And of course, consequently, our industry fell to, went off 80%, probably, very similar, tracking the commercial real estate market. So I guess in 2008 and part of 2009, I mean, we're just, just like a lot of you, the phone wasn't ringing, or if it rang, it made it very difficult to do the loan. Now, part of our problems is that our life companies have a lot of money, and they want to get it out. Interest rates are, as low as they've been. I mean, I think so. We were back in the heyday competing with the CMBS lenders. We were doing some loans at sub 5. I mean, we're doing a 10-year fixed rate loan today. Got a quote co-op mobile home park that we do with one of our life companies. It's 5.5%. It's a 15-year fixed rate term. But we can still do the same 5.5 on a 10-27. So that's pretty incredible. Problem is loan to values, where we used to do 75%, rarely might do 80, depending on, you'd have to be solid gold. I mean, our typical loan to value today is 65%. And there lies the biggest problem. Most of the borrowers that come to us for loans, and Mr. Repka here is in the same business we are, we work together a number of times. I'll try to give you some examples. I think examples work pretty well. We're working with a guy right now, big time developer, owns a lot of high-end properties, public centers, yada yada. He's got a loan with his current lender at $12 million. Now, he finished that center in mid-2007, top of the market, $25, $32 foot rents, rocking and rolling. The world craters, bank, as George said, said, your loan's maturing. We'd like you to pay it down a couple mil, we'll restructure your loan. And by the way, that 250 basis point over LIBOR loan that you have, well, we need to get 8%. But we're here to help you, like the government, right? Here to help you. So anyway, he's come to us and said, okay, what can you do for me? So, we get all the stuff in, we get the P&Ls and we get the rent rolls, and so we pulled it out to, all of our life companies love Publix. I mean, you got Publix Center, you got a great center. Chances are, your vacancy's never going to drop below 90%. And in this case, this particular center happens to be 92%. Problem is, in order to keep the tenants, he's had to readjust those rents from, like I said, 25 to 32. 14 to 17. So what does that do to the loan amount? Yeah. So the most aggressive loan that we can get for this guy today, and he'll sign, and he's got a huge statement and lots of cash. 6.5, maybe 7 million bucks. So what is that? I mean, he's 5 million in the hole. So what we're doing now is working with him, and we're doing this with a number of other borrowers. We are starting to get involved, working with him, going and basically representing him with his bank. Because the banks don't want to do anything for the guys. I mean, particularly if the guy's got a lot of money, and they're all these construction loans, or usually if you get a loan from a bank, you've personally signed it. You know, that's a serious issue. Because, you know, if you're in the real estate business and you start tubing your properties, you might as well go get a job as a Walmart greeter. That's where you're going to happen. What's going to happen. So, you know, in this particular case, we're going to, you know, work with him, try to negotiate a reduction in his mortgage, so he'll come back, maybe take a, you know, put $2 million of his cash in, they'll take a write-off of $3 million, and going down the road. And we just completed a deal that I actually started working on. I was telling Mr. Queen a little while ago, I started working on a deal last June. I'm leaving for vacation in the morning, and we always go to Lake Raven, Georgia, which is a fantastic place. And I started working on this loan. It was a fractured condo deal. One of my clients got involved, and it was basically a project that was geared to be sold to the Irish nationals. And the partner in the deal was a group called the Cathedral Group from Ireland, and they basically sold the vacation home aspect to the Brits. Brits vacation differently than we do. So anyways, they get the project. My guys were a joint venture partner with the Cathedral Group. We get the project built, bottom falls out. Out of the 82 units, they had 68 sold. They managed to close 12. The end loans that were coming to take the developers out were provided by an Irish bank. There are 3 banks in Ireland, they all failed. So they're sitting with a fractured deal, upside down, personally signed on this loan. So they came to me, and we've done a lot of business with these guys. They're out of Ohio, and they're design build guys. And so it took me 1 year. We were able to renegotiate that deal and buy that loan. It had an outstanding balance. I think it was about 8.2 million. I bought that note for 2.75 million bucks. Incredible, isn't it? And got them off their guarantees. So, and I'm working on a similar situation. We've got an industrial building. This industrial building's in the I-4 corridor in Orlando. It was NAIOP Building of the Year in 2007. 90,000 square feet, never been occupied. Now, you know, and the bank's out of Indiana that has the loan. So the guys have come to me saying, look, we're stopping. We're not going to pay on this loan anymore. You got some investors that might come in and want to take this thing in, da, 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 da. So, you know, I'm starting that process now with that bank, and I mean, I think the outstanding on that's about $4,450,000. I think we're going to buy that note probably around 2.6. So where does that go? I mean, we're seeing, and there are a number of other stories I could tell you like this. I mean, because and I'm sure we all in the business, you know what's happening. Gary Queen just told me he just recently inked 2 contracts on some fractured condos, both of them. Right, Gary? We got another one of our apartment developer friends from Canada, that Gary and I know quite well. One of our biggest clients just bought 2 fractured condo deals, and I don't know, is he closed yet? Yeah. That's an interesting thing. You know what money costs in Canada? 2.5%. You know, so if you got a big statement, you can bring that money down from Canada, and this guy does.